Welcome back to Crystal Ball. Let's get back to our conversation with Shankar Sharma of First Global. Where do you see light on the horizon in terms of, if you stretch this out, a period of pain in your eyes to a few quarters, by when do you think we can have resolution and markets generally can start improving? Can you see that time, or is it too dark for as long as you can see ahead?
Look, I think we are still quite high in terms of markets. We are still, 6, 7, 8% away from the highs, which means we are very close to the highs. If we were talking 25% away from the highs, then there was reasonable headroom that had been created. So I think we are still in that upper zone of where the market, can still possibly make an attempt for the high, which tells you that, there's not that much headroom left. It has to correct. And, I'm not a big believer in long-term trends of markets and all those kind of things, because just go back and look at forecasts that happened in 2007, how easily they were blown away 2008. Then again, how easily the doomsday forecast that the world will come to an end was blown away in 2009 March. So I don't believe, in making forecasts that when will the light sort of appear on the horizon, or vice versa. Let's just see this period through with our shirts intact on our back. And then we will live to fight another day.
Where do you see mid-caps standing at the end of this phase? Do you think they'll get brutalized again?
Well, I don't think mid-caps can lose a lot more than they have lost. But, when you become penny stocks, you look at a lot of our infrastructure companies, they have become virtual penny stocks. They are like 15 rupees, 18 rupees, 17 rupees. So, you will have like a 1 rupee move in them or a 50 paisa move in them, and, on the ticker it won't show up like it's just like, they're down 50 paisa, but that's like 5%, or, a rupee, which is like 10%. So that is the problem, that when you become penny stocks, then the moves can be in percentage terms very high. But in absolute terms, what do they stand to lose? They have pretty much lost all they could. So the mid-caps, I don't think, are incrementally going to hurt as much. I don't think people are even invested much in mid-caps. It's really the large caps, and I think the last time we met, I had said that banking is the area where you'll see the maximum damage. The market is down 5-7% from the peak. Banking is down, I think, 12% or 10 or 12% from the peak. And I think it's just getting warmed up. Because as I mentioned the last time, you can't have 4.5-5% GDP growth and expect the banks, which are service providers to this growth, to grow at 20, 25, 30%. That's completely irrational. And banks have started to really correct very sharply. In fact, they have been the big drivers of this current fall of the last couple of weeks. IT has held up, consumers have held up, pharma have held up, which are the traditional bear market trades, which is where we have advised people to get into in the last couple of months. Obviously nobody listens to that, but they'll start listening, I'm sure, in the next few weeks.
So where do you hide now, Shankar? If this is going to be a period of lot of volatility and pain, what can you be in at this point in time across asset classes?
You could be in Dubai, because that's just been included into the emerging market space, and that's a rocket market, 50% up this year. That's a good place to hide. So
for people who invest only in India.
Okay. I think really speaking, in this kind of situation, when things turn ugly, you have very little room to hide. And I've been talking to a lot of funds, even global funds, and they keep asking me the same question, and I keep telling them that as a long only, you really have very limited room to maneuver, because cash you can't sit on beyond 5 or 8%. So within this, the same bear market plays have to be bought, even though they look expensive. So I don't think pharma looks cheap or consumers look cheap, but they have to be bought simply to protect capital. Then you live through this period, and the trade will change, as it always changes. It'll change over the next few months' time. You might again have a sharp 30-40% rally, as we have seen, that happened in 2009. And at that point, you go out and buy risk, you buy the beta, you buy the beaten down. But right now, that is no time to be being brave. Just try and see that if the market falls 20, you should fall 10, you should not fall 40.
What about IT? Because of the way the currency has been moving, is that a hiding place?
Yeah, reasonable hiding place. In fact, in our note in March, we had said that it's back to the traditional favorites. You have to go away from financials and get into IT, pharma and consumers. And so far that trade is okay. I know in a market like this, you can't expect them to be up, but as long as they are slightly outperforming, I think you're doing okay. I think those trades will work in the months to come, without any doubt.